Hello, everyone, and welcome to session 4 of Financial Statement Analysis series by Financial Classes. My name is Shailesh, and we are going to talk about effects of revenue recognition policy changes in the analysis of revenue. Now, in our previous session, we discussed how to find revenue recognition policies and how to understand that revenue recognition policies. Now, for viewers who haven't taken a look at session 3 of our financial statement analysis series, I would request you to take a look at that video first before you move to this video. Now, in this video, we are going to talk about, now that we have understood what exactly company considers as revenue and how it records it, it's important for us to understand what implications this revenue recognition policy changes may have on the revenue figures. Now, to help you understand why this is such an important concept and why it should be taken a look at, we have taken a case study at point Kaveri Seeds. Now, Kaveri Seeds is into business of selling cotton seeds and likewise a couple of other seeds to farmers. Now, these seeds are sold, and for your benefit, what we will be taking a look at is how the business records its revenue and how it considers revenue to be recorded, and moreover, how the figures look and how to connect those figures with businesses through this analysis. So let's get started with the analysis. Now, what we have done is we have here annual report 2018. Now, what I'm trying to help you understand is, first, we will try to see how the revenue growth rate of Kaveri Seeds look like over the years, year on year, and likewise over a time frame of, let's say, 2013 to 2020. So I've just randomly put in one annual report 1 year so that you understand how the figures have been sourced. Now, for 2018 annual report, as you can see, we have discussed this in our first and second reading in how to go about understand the presentation of revenues and compute those revenue figures. In this annual report 2018, we can take a look at revenue from operations, but remember, this is yet to be subtracted. I mean, that's, the excise duty is yet to be subtracted. So from analysis standpoint, we take a look at net operating revenue after subtracting excise duty. For, again, we have covered this in our first 2 videos of financial statement analysis series. So for users who haven't taken a look at that video, I would request you to take a look at that video first, and then we'll move on further with this video. So how is 2017 revenue recorded? It's basically 7065 minus 136. So we know it's nearly somewhere around 70500 or somewhere around that number. If you subtract this, and precisely the figure which you see here in our 2017, 70499, more or less, that was just a rough calculation orally because the figures looked very much close. So 70499. As you can see, similar fashion, we have also extracted 2018 figures here, 81937 minus 13. So that's going to be 819 around 24 or something. So 89286. So now 89286, that figure may look slightly different as compared to what we see here. That's because we have always talked about sourcing the figures from the latest annual report. So 2018 annual report, or rather 2018 figures should be sourced from 2019 annual report rather than 2018 annual report, because there could be some bit of corrections here or there, not much material, unless if that difference seems to be huge. An analyst should take a look at why that difference is so huge. Now, in this case, that difference is not so much material, so which is where we can simply ignore that part and take figures from 2019's annual report for 2018, just the way we are taking 2017 figures from 2018 annual report. Now, I've just taught you how to collate these data in a time series fashion. Precisely by doing that, again, you can take a look at 2016 figures from here, 74530, and if you were to subtract 41 lakhs as excise duty, you should get 7449 something. So 70499. Likewise, you get 2017 and 2016 figures may seem accordingly from 2017. Now, a lot of you guys may think that the 2016 figure is not really matching with what we have there, because as per 2017 annual report, the 2016 figures are very different. So, let's actually go to 2016 annual report. So when you take a look at 2016 annual report, the 2016 figures are very different as compared to the ones we saw in 2017 annual report, 2016 figures. So let me just write it down. So I know there's just a lot of numbers, ताकि आप confused now. Let me write down the figures. So these are 2016 figures in 2017 annual report and 2016 annual report. And precisely the reason why we are conducting this analysis. So, you guys understand what exactly is happening here. So 2016 annual report, if you were to take the figures, this minus excise duty figure. Now you don't really see excise duty figure here, because if you actually open the footnote 19, you'll see that, excise duty figures have been subtracted from here. So I'm just going to directly take these figures here, and let me just convert it into lakhs so that they are comparable. So dividing it by 5 zeros, you should get 8. Sorry, let me use different colors so that it's easier for everyone to read. 89277.9. Now that's precisely the revenue figure of 2016 from 2016 annual report. Now let's note down the revenue figure of 2016 from 2017 annual report, so that we understand the root of confusion here. So 2016 annual report figures would be 74530 minus 41.77, more or less 74490, somewhere around that. So I'm just going to write 74490. Now, as you can see, this difference cannot be ignored. This is huge. The difference is not really a small one. So, to find out why exactly this difference is coming, you need to take a look at first, did the company change the way revenues were recorded? So let's take a look. I'm just going to keep these numbers here on the screen so that we are able to distinguish it properly. So to understand whether the company changed the way they record revenue, you need to go to revenue recognition policies of 2017 annual report and 2016 annual report. So because the 2016 year was same, but in different annual reports we could find different figures of 2016. And trust me, the difference is not because it's standalone or consolidated, because in both the annual reports the figures are from consolidated, as you can see as well. So it's the same company, consolidated figures, but still for both the years there seems to be a huge difference. So the first thing which you should do in such a case is check whether the company has changed the way revenues are to be recorded, and whether if they have made any restatements is something we are going to cover in the next lecture, how to go about analyzing revenue restatements. So anyways, let's stick to the revenue recognition policy for now. So if I were to, so this is for everyone's benefit, this is annual report 2017. So if I were to open page 154, you will find the revenue recognition policy. So revenue recognition policy, all you need to do is understand how the revenues are recorded. Now, if you take a look at the last paragraph, just take a look at this. Let's read it together. So revenue is measured at fair value, consideration received or receivable after deduction of any trade discount schemes, volume rebates, any sales taxes or taxes collected on the behalf of government, value added tax, and etc. Those are subtracted. Now, precisely a standard way where we saw even in Hindustan Unilever Limited and likewise, right? But let's take a look at the revenue recognition policy of 2016 annual report. Now I've just switched window to 2016 annual report. Let me just open page, I believe it is on 131. So page 131, when you take a look at the revenue recognition policy, you will see that the revenue is actually recorded is net of sales returns and sales tax. There is no mention whatsoever of. So did you notice the difference, by the way? If you take a look at the 2017 annual report, once again, let me just toggle the window. Let me just toggle the window so that each and every one of you is, well aware of what's happening around you. So just read this part once again. I mean, after deduction of trade discount schemes, volume rebates. Now, this is not really present in 2016 annual report. So to define, again, I'm writing it here. This is excluding trade discounts or sales schemes. So trade discounts, or let's just call it sales schemes, as mentioned in the, so this is excluding figure. And this, as per the 2016 annual report, let me just once again toggle to 2016 annual report. There is no mention whatsoever of sales scheme here in the revenue recognition policy. So as you can see, the revenue computation changed. Now, how do we verify this? Whether our understanding is right, to help understand whether what we are trying to infer from the revenue recognition policies, let's do the maths. Like, let's try and go to the financial statements and find out whether the trade discount figures are genuinely missing in 2017 annual report corresponding to 2016 figures, right? And whether they are present in 2016 annual report corresponding to 2016 financial figures. Let's take a look. So let me just open the income statement, which by the way happens to be for 2016, it happens to be on page number 130. When you take a look at the income statement, you will notice that it has revenue from operations, other income, and there is no such line item which mentions trade discounts or sales discounts. Does that mean it's missing? No, it could very well be clubbed into these line items, right? So, something which stands out as other expenses because it could very well be part of other expenses. So let's open footnote number 25, which may very well have that trade discount or scheme discount figures. And this page, or rather this footnote number 25 is on page number 142, if I'm not wrong. Yeah. So as you can see, this is the footnote number 25, other expenses. When you closely observe, you will see a sales scheme figure. Now, you may be thinking, let's actually cross-verify. Like, let's open 2017 annual report and see whether that sales scheme figure is missing in 2017 annual report, because precisely that's how they have started reporting revenue in 2017 for 2017 as well as 2016. So let's open the annual report, or rather other expenses footnote of 2017. So let's first find out the footnote number, which would again happen to be in the income statement, which is there on page 148. Now the footnote number for other expenses is 40. Remember, the footnote numbers can't really be same across the years, right? So you need to be vigilant about that. No, this footnote number 40 is present on page number 177. Now, when you open this other expenses footnote, sales promotion is there, but sales scheme is missing. Let me just toggle the window. Sales promotion is there, then advertisement is there, but sales scheme is missing. Now, some of you guys may be thinking that it's quite possible, the sales scheme figure got clubbed with some other header, right? But the sales scheme figures are actually huge. I mean, just take a look at this. And remember, this is a business which is dealer driven. Now, dealers usually tend to get sales schemes discounts around 10 to 20%. So that's a huge number of the top line. So 20% of this figure, or roughly 892 crores, is going to be huge figure. So it can't really it can't really be clubbed or shied away from directly that easily. So when you actually take a look at the nature of the figures, you will see that figure to be completely missing from the other expenses footnote, because in the first place that sales scheme number was subtracted from the revenue. Now let's do the maths and verify ourselves, right? So if our conviction, because see, now we have opened the figures, we have taken a look at the footnote, we understand that it's missing in 2017, and 2017 revenue recognition policy explicitly mentions that, hey, we are recording revenue after deducting sales schemes or trade discounts. However, in 2016, they made no such statement whatsoever, which is why we see a sales schemes in 2016 annual report. This is, by the way, 2016 annual report, what you have in front of your screen. So let's actually cross verify if we were to subtract this sales scheme figure from the reported revenue of 2016 in 2016's annual report, do we get 2016's revenue reported in 2017's annual report? Hope that is clear. If you don't really understand, let me just quickly repeat. So what we are going to do is, we are going to cross verify whether this figure, if it is subtracted from the sales scheme discount, which we see here, do we get this figure or more or less, in the same range? So let's actually, sorry, by mistake, I grabbed the numbers there, 7.4. Okay, let me just quickly open the statement. By mistake, I erased the revenue figure, which is there on page 148. So the revenue figure for 2016 in 2017's annual report was 7.4. If you were to subtract this, 7.4490. So there was a 0 here. Sorry. Yeah. 7.4490. All right. So, let me just quickly toggle back to 2016 annual report. Let's see if we subtract the sales scheme discount figure, which is present here, from the revenue figure reported, do we get the revenue figure more or less reported in 2017's annual report? All right, so let's do the maths. So 89277.9 minus, if you were to convert it into lakhs, you should be able to get 14793.5. So if we were to subtract this 4, I know I'm going old school here, so bear with me. 4, 5, so 4 and 7. So 74484. Very much close, right? So hope you get the logic here now. So what has happened now? Let me just quickly recap. So starting 2017, all figures are reported net of sales discounts, which, by the way, happens to be huge in case of a business like Kaveri Seeds, ranging in the domain of 10 to 20%. So all figures reported. So, let me just use a wide screen here so that I'm able to communicate what I'm talking about. So starting 2017, all figures, beyond that are actually excluding sales discount. And before 2017, let's say 2016, 2015, 2014, 2013, these would be all including sales discount. Now, if an analyst were to actually compute the revenue growth rate of this business from 2014 to 2020, directly taking figures from, let's say, a data vendor, who, by the way, wouldn't do this for you, would be, because he would be taking directly the reported figures, right? If you were to take data directly from the annual report reported and compare this including sales scheme discount to the revenue figures excluding sales schemes discount, the business would look nearly flattish. Let me show you. We have done that analysis for you guys. So, this is precisely the table which I was referring to now. Take a look at this. The figures from 2016, 89286, these are including. So the years which you see here, 2013 to 2016, are including sales discounts. Pardon my handwriting. But after 2017, these are excluding sales discounts. So if an analyst were to compute, so these are 2017 excluding, and these are including. So including as in the revenue hasn't been subtracted with the sales scheme discount. So if you were to calculate a 7-year CAGR, a revenue CAGR from 2013 to 2020, let's say, that CAGR would look like, the business grew from 712 crores to 930 crores. Now that CAGR would come around to be just 4%. Another angle of actually catching this would be business analytics, like connecting the figures with business. It's a brilliant way of actually finding out if, business is trying to tell you something else, but the figures are trying to tell you something else. So the easier way one could have caught this, a simple business logic would be this. So if you were to take a look at, the 2016 year-on-year growth rate, so as compared to 2015, you see that the business went down, the top line directly shrunk by 23%. Now that's humongous. Now, whenever something like this, this huge or this phenomenal happens with the business, you should always take a look at chairman's speech. So let me just open annual report 2016, precisely because if you take a look at this, the revenue shrunk in 2016. So if you open 2016 annual report and you go to chairman's speech, you will get a very good color on what exactly went through or what exactly happened with the business in 2016. It says that, the business or the entire India saw the worst drought ever. Now, remember, this is majorly driven, agriculture driven business, right? So in case if there is a terrible rainfall or a monsoon season in India, it's the seeds, the farmers suffer because they don't really buy seeds. And obviously the business which is actually selling those seeds, those businesses suffer. So which is why, the business suffered crazily in FY16. However, if you open FY17 annual report, you will see that, there was a very good rainfall in India. Now, still, if you were to take a look at the revenue figures, comparing 17 and 16, you will see that the revenue went down by 21%, which doesn't make sense. In a very good monsoon year, how can revenue go down? Especially for such a business, which is completely monsoon driven. So 2017 saw very good revenue, so very good monsoon. They should have seen, a very good business as well, right? And why is that? Because the revenue figures which you are comparing it with, this was including sales discount and this was excluding sales discount. There's more or less a 15 to 20% incorporation already. So like, it's like, let's say 100 rupees ka business ho raha tha, and there was a 20 rupees discount. In 2018 or 2017, you reported this as a revenue line item of 80 rupees, without showing the calculation here. Let me just write it down, 80. And in 2016, because the revenue figures were including sales discount, where the sales discount was part of other expenses and where the other expenses was nil in 2017 comparable wise. What an analyst was doing here is comparing 16 and 17 figures and concluding the business went bad, especially in a season where actually there was a really good rainfall. So which is why comparing 180 would be stupid. An analyst would either need to add 20 to this, either you find out the sales discount figures for 2017 onwards, adjust it to the revenue, which by the way wouldn't be available because revenue was already reported excluding those sales discounts, and there's no such other footnote available where you will get the sales discount. So another method of actually making these figures comparable across years would be you subtract 20 from the reported revenue of 2016. Yes, you need to source the sales scheme discount figures from the other expenses footnote, which we just saw in 16 annual report on page number 142 in the other expenses footnote, where we actually saw the sales promotion, or sorry, the sales scheme discount figures. You need to use these figures, subtract revenue from them, and then use them as comparables. That is what is going to give you a good picture about the business, rather than blindly comparing figures, taking data from vendors. Now you understand why it's so important to take a look at revenue recognition policy. Let me do that for you. We have done this, by the way. You can read this. By the way, one thing which we want to explicitly mention, just because the revenue has gone down or revenue has increased by a huge margin doesn't mean that revenue recognition policy has changed. One needs to be very well aware of the business environment, which is why, like I said, there were two ways of doing it. If numbers have drastically changed, as a safety check, just check whether the revenue recognition policy has changed, or connect it with business logic by reading the chairman's speech. A brilliant way of doing this. Now, what we did, just the way I explained, taking the first thing which you should do is take the revenue figures. Now, this is what we have done for you. What you see on screen is, revenue from operations, excluding excise duty from the footnote. This, by the way, happens to be footnote number 19, as you can see on screen. So this is footnote number 19 from the annual report of 2016. So and like we mentioned, all 2015 figures should be taken from 2016 annual report. So precisely what we are doing, taking the revenue from operations, verifying whether it is excluding excise duty. Yes, it is. Taking those figures, and is our job done? No, not really, because the figures prior to 2016, all of them had sales discounts being part of the revenue. So we need to exclude sales discount from the revenue to make the figures prior to 2017 comparable to figures post 2017. Precisely what we have done here for you guys. So, taking a look at the other expenses footnote, you will see sales scheme discount figures to be this. Take those figures, subtract sales scheme, and then report net revenue. So precisely what was happening is, before 2017, the revenue which was reported was gross of sales discount. So we had to make it net of sales discount. And beyond 2017, anyways, the figures were reported net of sales discount. So now the revenue figures are comparable. So when you take a look at 16-17 growth rate, it's a slight degrowth, not really 21% drop in revenue figures. Thank God for a good rainfall or a monsoon season. Now, if you were to compute a 7-year CAGR, which by the way, you can find the formula here, you will see it to be 6.4% precisely. Now, an analyst who would have directly sourced these figures from a data vendor would have concluded that the business is not really growing. And perhaps in 2017, they would have concluded it's a bad business despite a good monsoon season, because you took the wrong figures in the first place, my friend. Like I said, financial statement analysis is a 3-step process. Learn how to source the data. Second, understand the data, and then move with the analysis. If you don't really understand the data, directly jump to the conclusion for the analysis part, you will get wrong conclusions. Now, so precisely, the revenue figure which you see, do you see this drastic difference? Now, you may be thinking, what's the big deal, 4% at 6%? Yeah, wait till you see our valuation series, you will realize how the revenue growth rates eventually materialize into huge valuation figures for a good business. Now, all right, so precisely what we wanted to cover through this, this season. Now, this particular session. Now, if you actually, have this, by the way, you can also, if an analyst were confused in this situation, they could have also got on a con call with the company and asked this question, precisely what an analyst did. Let me show you how to source con call transcripts for a company. You could either go for a, the BSA announcements, or you could also go to companies and, website. If you go to the financial section, financial information on the investor section of any company's website, you will see annual report, investor presentations, likewise financials. You will see a transcript of a conference call. Now, remember, when did this event happen? Everything changed in FY17, right? Because FY16 तक including sales discount चल रहा था. So FY17 का अगर मैं Q4 का con call open करता हूँ, maybe, hoping that someone would have asked it back then. Browser is not responding. But anyway, so if you were to open the Q4 con call of Kaveri Seeds in 2017, you would see that an analyst actually asked this question. Whether the revenue figures seems to be a bit off. Are they net of discounts? And precisely the company confirmed this. This is present on page number 7. Let me show you guys. I'm just referring to the question asked by Dhiresh Pathak. I'm referring to slide 20. You said you are sharing revenues, net revenues, correct? This is after dealer discounts. So Satish sir replied, yes, in the past we used to share, gross, but under the new reporting standards, we have to share net of all discounts. A very, very interesting data point. So precisely when you were to compare figures now, which is where it comes to the tail end of today's session, the art of actual data punching is highly underrated. A lot of people don't really do that because, see, it's very much understandable when you have a lot of companies to analyze and you want to use a couple of filters to figure out which companies you want to, do a deeper dive into. However, if you were to, one should be aware of the opportunity cost for the same. Like if you don't really have a deeper understanding of figures, the shortlisted companies might actually also have a wrong picture. So, whenever you analyze any particular business, get into a habit of actually punching figures from the primary sources. And whenever you have any such intuitions, or rather, a leap of faith which you are taking, try to verify it from primary source once again, either through credit research report, con call, investor presentations, and likewise. You'll get wonderful answers out there. All right, with that, we'll end today's lecture. Hopefully you guys liked today's session. Please do subscribe to our YouTube channel. You can also follow us on Instagram. Our handle is Finacle_Shah. For more informative content around valuation series, business analysis series, you can also follow us on YouTube. In case if you have any questions, please feel free to comment on the video or on our blog, which is present in the forum section, Financial Statement Analysis Series. Thank you so much. I look forward to having you guys in the next session.